So, with all the pressure on Europe at the moment, with countries collapsing one by one, domino style, we're going to take a look at an important warning indicator of trouble in the markets, the so-called credit spread. Now, in order to take a quick look at this, I need to make an assumption, which is that you understand bond basics. Now, if you don't understand bond basics, very quick recap coming up, but it's going to be brief, so take a look at my videos, Bond Basics and Bond Basics 2, before diving into this one too much further. Okay, so what are credit spreads and what do they reveal? Well, basically, in order to understand a credit spread, you need to understand a bond yield first. So a very quick reminder coming up. Let's take a 3-year IOU, so a government bond. And by the way, credit spreads are related to the bonds market specifically and the risk associated with bonds. So let's say I put £94 in now to buy a bond. That means I take or buy a piece of paper from a government, an IOU. It's going to last 3 years, 1, 2, 3, and at the end of it I get £100 out. I know that because bonds redeem at their nominal value, and that's fixed. For a UK bond, that typically be £100 or £1,000. So I'm buying a bond for 94, and in 3 years' time I get £100 back. So it's like making a loan. £94 in, get £100 back. And let's say this bond, like many government IOUs, is fixed coupon, so it's going to pay me £2 every year for the next 3 years. Alright, so there's the deal. I can pay £94 now to get £2 a year for 3 years and £100 back at the end, just like a simple loan. Alright, so basically governments issue these IOUs, and if I decided to buy one, I could do a very rough and ready calculation of the total return, the yield. And I need that to understand credit spreads in a moment. So on this one, ignoring the time value of money, which I'll leave to another video, the yield annually is simply the income that I get, £2, plus, well, there's a gap between the price I pay and the amount that the issuer will pay me back in 3 years' time of £6. So let's call that £2 a year of capital gain, so that's another 2, over the price I'm paying to buy the thing, which is 94. So 4 over 94 as a percentage is an annual yield of about 4.25%. Right, now that was a bit quick, see my Bond Basics videos, and I have cheated a little bit here with that number. I've ignored time value of money, so that isn't quite the full calculation, but in principle it gives me a rough indication of the yield on this type of bond. Now, before we get to credit spreads, there's another way to say that. 4.25% in market jargon can be expressed as 425 basis points, or BPs, or BIPs even. And basically the way that works, it's just a bit of jargon, is 1 basis point is 0.01 of a percent, so there are 100 basis points in 1%, so you can express any percentage in basis points. So 100 basis points is 1%, 4.25% is 425 basis points. The only reason that matters is that you'll see commentators refer to changes in basis points sometimes, and that's how you convert it into a percentage if that's what you prefer to use. Right, now where do credit spreads fit in? Well, a lot of commentary about credit spreads, journalists from banks, from all sorts of people, because basically if I were to look at sovereign debt, that's government IOUs, maybe what I do is I look up the yield that Italy is having to pay on 10-year IOUs. Now 10-year are quite common benchmark IOUs. The Italian government issues them over shorter periods, 2 years. 10 years is about medium term, if you like, and there are longer dated ones too. When you're comparing governments, typically the 10-year IOU is the one chosen. And the Italian IOU, the 10-year maturity, let's say, is offering a yield, well, of around 7% at the time this video is shot. So about 7% or 700 basis points. Now, what does that tell you? Not a lot. As an isolated number, it doesn't tell you much. We know, for example, in the past, governments such as Greece, Ireland, Portugal, that have been forced by the bond market, that's by investors, to pay as much as 7% on their IOUs, have hit problems and had to ask for bailouts. All right? So, as soon as Italy's percentage or any of the big economies goes over 7%, as soon as investors want 7% or more, people start to ask the question, is anyone willing to actually lend money at that kind of rate? Because as an investor, your worry would be that the Italians snaffle up the money that you put into their IOUs and they just use it to pay interest on existing debt, and that's about it. And investors don't want that to happen. So yes, in one sense, 7% is an absolute high level in that it's caused other governments problems. But actually investors like to say, well, in relative terms, is that high? And here's where spreads come in. Because you could compare Italy to, say, Germany. You could compare one of the riskier economies, as is currently seen, in the Eurozone, to what should be one of its safest, the German economy, the German powerhouse economy. And let's say you look up the equivalent return investors are demanding for buying German 10-year paper, and you get more like 2% or 200 basis points. The spread is the gap between those two numbers, or if you prefer, between those two numbers. But quite often the commentators refer to the spread in basis points. You'll hear people say things like, oh, crikey, at the moment there's a 500 basis point spread between German medium-dated IOUs and Italian IOUs. Okay? And here's some more jargon. The wider that spread, the greater the risk. And the faster the spread widens, the faster risk is perceived to be sort of gathering momentum. So in recent days, for example, we've seen this widen quite dramatically and quite fast. Okay, there was a time when these two numbers were much, much closer together. All right, but people are now perceiving that, oh crikey, in a worst case scenario, Italy might even be kicked out of the euro. All right, and investors are dumping Italian bonds. And don't forget that if investors sell Italian paper, sell these IOUs, what's that going to do? It's going to push the price down, P, and the yield up, which is exactly what's been happening. Okay, because don't forget the income on these things is fixed. Okay, and they're also redeemed for a fixed nominal value. So investors can basically push the yield up or down by buying or selling the bond. And of course, Germany is seen as a kind of safe haven. So at the same time, quite a few investors are buying German IOUs, and that's tending to push the price up and the yield down. So you've got a kind of double whammy effect that's pushing this gap wider and wider and wider. All right. Now, do people just compare two countries like that? No. The other country that gets thrown into the mix at the moment is France. The reason is that anything up to 40–50% of all of the debt exposure of any country to Italy is French. Okay, and in particular certain French banks. So people are also looking at the spread between German 10-year bonds and French, and that over recent days has been widening too. So in a nutshell, a spread, expressed usually in basis points, is a snapshot of relative risk in the bond markets, and as an investor, trouble is ahead when you see one of two things happening. If you see the spread widening, that can spell trouble, and if you see it widening fast, that spells even more trouble.